Welcome to this financial review about Eli Lilly with their last financial figures that they released the last quarter ended on June the 30. Eli Lilly, as a general information for those who doesn't know, was founded in 1876 as a company in the global pharmaceutical leader dedicated to improving lives through groundbreaking medicines. Headquartered in Indianapolis, Indiana, Eli Lilly is best known for its innovative treatment in areas like diabetes, oncology, neuroscience, and immunology. Over the year, the company has brought life-changing drugs to markets, including insulin therapies for diabetes and cutting-edge cancer treatments. Eli Lilly prides itself of being at the forefront of medical research and development, continuously pushing boundaries to tackle some of the world's most challenging diseases. Beyond innovation, the company is committed to fostering patients' access to treatment, supporting healthcare professionals, and promoting sustainable in its operations. With a presence in over 120 countries, Eli Lilly is not just shaping the future of medicines, but also making tangible difference in communities around the world. As a symbol of scientific excellence and compassionate care, Eli Lilly remains a trust name in the pharmaceutical industry, delivering hope to millions of patients and their families. After this general information, I would like to start with the green flags of the information of the financial statements released that as of June 30, 2024. The first green flags that I see is the strong revenue growth. Revenue increased 36% year over year for the 3 months and June 30, 2024, and 31% year over year for the 6 months and at the same date. This indicates robust demand for the company products or services, as a strong competitive position, as effective execution of its markets. Operation income growth is the second green flag that I see. The GAAP operating income grew by 75% YOY for the 3 months and at June 30, 2024, and 72% year over year for the 6 months. On a non-GAAP basis, operating income grew 20%, 90% year over year in the second quarter and 79% year over year for the 6 months. This signals strong operational efficiency and cost management, particularly as gross margin also improved. We are going to see in some few minutes which is the difference between non-GAAP operating income and GAAP operating income. GAAP are the US accounting principle general accepted in the US, right? And non-GAAP are on the basis of IFRS in the rest of the world. The third green flag that we have are earnings growth and profitability. GAAP net income grew 68% year over year, and non-GAAP net income grew 86% year over year. Similarly, earnings per share grew 68% YOY on a GAAP basis and 86% YOY on a non-GAAP basis, a strong signal of shareholder value creation. We are going to talk some few points about red flags for me. And the first one is a rising cost of R&D and SG&A. Research and development R&D expenses rose 15% YOY for the quarter and 21% YOY for the 6 months. Marketing, selling, and administrative SG&A expenses also increased by 10% year over year for the markets and 11% for the 6 months. While R&D investment can drive innovation, sustained increase in this cost may pressure margins unless revenue growth continues at current rates. The second red flags that I see is the net negative impact of other income. The other net income expense line shows a net negative expense of $197 million for Q2 according to US GAAP, and $170 million for the 6 months. Although adjustment in non-GAAP metrics reduce this impact, investors should investigate that drove those cuts, as they may include volatile or recurring factors like interest expense or foreign exchange losses. The tier red flags that I see are asset impairments and restructuring charges. The company incurred 435 million in asset impairments, restructuring, and other special charges in both Q2 and 6-month period, though these were excluded in non-GAAP calculations. While such charge may be one-time expenses, they could suggest inefficiencies and underperforming assets that require further restructuring or write-downs. Also, in the red flag portion of the analysis, they have an extremely high valuation ratio. They have price over equity in a ratio of 80.6 and 128.6. These multiplies are significantly above historical average for most industry, signaling that the stock may be overvalued. Price to revenue 17.34, which is high, suggesting investors are paying a premium for each dollar of revenue. Other important flag, Other important red flag are high debt levels. Total debt to equity is 218%, indicating the company has more than twice as much debt as equity, which raises concern about financial leverage. Quick ratio 0.97, indicating tight liquidity. A ratio below 1 means that company might struggle to cover short-term liabilities without relying on inventory sales. They also have another red flag, which is a weak tangible asset base. The price to tangible book is 366, suggesting the company has minimal tangible equity. This could imply that a large portion of the company's valuation is based on intangibles, such as goodwill or intellectual property, which might not hold their value in a downturn. Investor implications. The first one, valuation sensitivity. The stock high valuation ratio suggests that future growth is already pricing. Any earning or revenue miss could lead to a significant drop in the share price. Debt risk. While the company has been leveraging its debt effectively for growth, as reflected in ROE and revenues metrics, the high debt to equity ratio makes it vulnerable to rising interest rates or economic downturns. 3. Growth potential versus tangibility. While intangible-driven valuation isn't necessarily a bad sign, as an example in technological firms, investors need to assess the long-term sustainability of these assets in generating returns. Well, this is a summary of my financial review of the last figures from Ely Lilly, LLY, in the stock market. So this could be an additional input to your own research. If you ask to me if I would invest in Ely Lilly, I already do, but you have to constantly review the behavior of the stock price, right? This is a fundamental analysis, and you have to do your own research and your technical review, right? So this is what I have for today. And let us know what do you think about this, and let us know what additional companies would you like to see this kind of review in the future. Thank you very much for your like, for your subscription, and let us know in the comments all your input. Everything is well received and really appreciated from you. This is Eric Mendez, and this is a channel that pretend gives you support in your financial decisions. Thank you. Bye.